Well, folks, welcome back to Business Talk here on businesstech.co.za, where we try to make sense of the financial chaos unfolding around us. Today, I'm joined by a man who spent years peering into the abyss of banking and markets and economic structures and hasn't yet decided to flee to a remote island somewhere. David Buckham, the founder and CEO of Monocle Solutions. He's built a career deconstructing the grand narratives that drive our financial system and the cognitive biases that make us, and let's face it, often make us terrible investors. He's also the author of several books, including the 2021 bestseller, The End of Money, and last year's Orthogonal Thinking, which I suspect is going to inform some of our conversation today, David, because we're here to talk about a range of topics, a lot of it stemming from what's going on in the US equity markets and more broadly around artificial intelligence. But it feeds into this idea that you floated of grand meta-narratives in orthogonal thinking. So great to have you on the show. Maybe let's just
Thank you, Michael.
begin. Let's have a look at the US equity market and you and I have discussed this privately. But I was having a chat to Anton Esser, who's the chief investment officer at 10x, and he's in agreement. He's argued for some time now that if you look at the valuation measures, the S&P 500's CAPE ratio is above 38. It's expensive. These are levels that historically have never resulted in positive 5-year returns. Why do you think it is that the US equity market is overpriced? Is it irrational exuberance, or is there actually a case to be made that this time just maybe these sky-high valuations are justified?
So definitely there are two conflicting narratives. On the one hand, there's the argument that we live at an inflection point in history, and therefore the valuations are justified, where you've got the top 20 companies, I think 17 are from the US, and NVIDIA's number 2, Apple's number 1, Google's up there, Tesla's number 8, worldwide valuations of companies that have adopted or are adopting or are using the AI narrative. And by the AI narrative, I mean that this will change everything: automated cars, self-driving vehicles, self-driving trucks. This will change everything. This will change our efficiency levels, etc., etc. So if that's the one side, that would justify the argument for overvaluation. On the other hand, there's an undervaluation argument, which is an overvaluation. On the other hand, the market is radically, if you go back to just basic economic theory, the market is at a 28 times multiple of earnings. So the weighted average S&P 500 company is worth 28 times last year's earnings, so historical earnings.
Yeah.
Even more in Apple, which is the number 1 company in the world in terms of asset size, is in terms of market cap is $3.8 trillion a company, which makes cell phones, as we know, and its price earnings multiple is 41, which is quite a big number if you contemplate that it's the largest company in the world and that it has already sold its main product to most people.
No, I mean that's a multiple that you could justify if you're a high growth startup and you're growing earnings, at 20, 30, 40% consecutively over the next few years. You'll grow into that, absolutely. But to your point, if you're a behemoth who's almost utility scale, so it does beg the question. And I think, if the past decade has taught us anything, it's that markets have an astonishing ability to extrapolate. Investors love a good narrative, and the dominant storyline of the last 2 years, especially, has been NVIDIA's kind of AI-fueled ascent. Then we had DeepSeek, and I think DeepSeek arrived and kind of pulled the rug on all of this, because we thought, well, here's NVIDIA with its GPUs and this big moat, and it lost, what was it, maybe $600 billion in market cap in a day?
Yes.
What does that tell us about the AI narrative?
I think Well, can I give you one other example of just a crazy statistic, like a mad statistic? The company Tesla, which makes electric vehicles, owned by Elon, or started by Elon Musk, owned by investors, is currently trading. I worked it out, Michael, last night on my airplane flight from Paris. Its last year's earnings were $9.34 billion, which makes it the 157th largest company in the world in terms of earnings. But it's the 8th largest company in the world in terms of market cap. It's trading, Michael, at a current market cap of 102 PE, 102 on historical. 102. Bear in mind that it's a company that makes electric vehicles, that it has declining demand, right? There is declining demand in electric vehicles. And with the Trump trade tariffs, there's a problem of selling into other markets, in that the cars will be tariffed. And then there's disappointing news out of China, which has not given permission to Tesla to test the self-driving trucks. So there's also been a sort of anti-Elon Musk response from a number of countries, such as Canada and Mexico. And even in America, people are not happy with Elon Musk, so they're moving away from Tesla. But it's still priced at 102 earnings multiple. And I did some research, Michael, for this conversation. Did you know that PayPal, which was also founded by Elon Musk, is now worth 5% of what it was worth when it first launched? So if people wanted an example of a narrative where I would go short Tesla. I'm not an investment advisor, and you shouldn't take my advice because I'm not authorized to give investment advice. But the S&P 500 is trading 28 times versus a long run average of 18 times. It's driven primarily by market exuberance, by the gambling mentality that was unleashed during the COVID years, by greed, by market forces, which are, I mean, and a sobering statistic is the S&P 500 in the Financial Times is published every day, and there's 6 columns. It takes up half a page in the 6 columns. It's in like fine print. 3 of the columns are the U.S. markets. So it's the 500 largest companies in the world, and 3 of the 6 columns in the newspaper are American companies. And America, as we know, is the holder of the world's fiat currency and is currently indebted. U.S. government debt is at an all-time high, and the stock market's at an all-time high. And I think we could all agree the one theme, that's the one major theme that I wanted to highlight, which is the overprice of the markets driven by the AI narrative. But just before we go down the discussion about the AI narrative, I wanted to point out another major theme for me is the probability or possibility or probability or likelihood of a major terrorist attack in the US or the UK or Europe or even Africa is multiples, orders of magnitude higher than it used to be, because there's currently a kind of destruction of institutions under the Trump regime, where people are being laid off. People who work in the park rangers are losing their jobs. Attorney generals are losing their job. I mean, there's many examples, and you'll recall that it was after September 11th, 2001, that America implemented anti-money laundering, anti-counter-financing of terrorism, which was implemented by the banks. And in a world in which we're going to have deregulation of banking, which might include market conduct, and the accusation that the FBI was deep stated under the Biden regime, and Kash Patel is now unearthing that, is really scary, really scary. Right now, there's a litigation taking place between Apple and the British government over their desire to get into the iCloud and to it's called the Snooper Charter. So something that I'm concerned about, aside from the theme number one for this year, would be there must be a market correction, at least 30% market correction. As soon as the AI narrative runs out of steam, there must be a market correction.
David, I want to get your thoughts on what's actually going on in America at the moment, because I just find it remarkable to, as an outsider, watch what's going on in terms of regulatory capture. You see the president surrounded by Silicon Valley. At his inauguration, he had Elon Musk, Jeff Bezos, Satya Nadella,
Everybody.
Tim Cook. And
Mm.
and recently you saw the deputy president, JD Vance, jet over to Europe at a conference where they're talking about the responsible regulation, the safe regulation of this technology that that has the ability, if left untethered, to allow terrorists, for example, to access ways to create chemical weapons, or initiate some kind of cyber attack. And you talk about these risks. And he stood up, JD Vance, and said, no, we can't regulate, and we don't need guardrails, because effectively what we're going to do is we're just going to stifle innovation, and we must allow US tech companies to innovate, because we're at risk of being out innovated by China. So that was his argument, which to me sounds like a bit of a straw man argument, and is really just out there to protect the interests of the kind of tech oligarchy that we're seeing emerging in the US.
Yes, I agree with you 100%. So people might not know this, but JD Vance was one of the interns under Peter Thiel, and was involved with Palantir Technologies, and was part of that kind of private equity mafia, so to speak, the West Coast private equity mafia and the hedge fund mafia. So to my mind, it's very, very clear that Trump has surrounded himself with billionaire West Coast bros whose interested is to create companies that supersede nation states, so that these companies have got no regulation that can stop them developing AI. I mean, we've discussed this before. Open AI is a non sequitur. I mean, it's not open. It was started by Sam Altman as a non-profit company, and now Elon Musk and Sam Altman are battling with each other because Elon Musk wants to own it. So these people are completely out of touch with the needs and values of liberal democracy, and they're pushing narratives that suit their agendas. One of the strangest things that has happened in world geopolitics happened just the last few days, where Marco Rubio met with Sergei Lavrov in Saudi Arabia to discuss ending the Ukrainian war, without inviting Ukraine to attend the conference. So it does seem also sort of extremely disturbing when Trump demonstrates a complete lack of understanding of Middle Eastern politics in suggesting that Gaza become the Riviera of the Middle East, and we'll use the land. So roughly speaking, I wish to point out, as I'm sure many of your listeners will be aware, that a half of global markets, global equity markets, and by the way, also of bond markets, I can get back to that, a half of markets, debt and equity markets, more than half actually, is centered in a country whose leadership has pivoted away from NATO and liberal democracy and Kantian values to friendship with China and to penalizing its long time neighbors and friends and stopping all aid to Africa. So to say that we live in uncertain times is such an understatement. And then you look at the price of the market and go, if I want to make money in this market, I'm going to short the market.
Yeah.
And it's a question of how long can this go on? If you look at certain graphs, for example, the price of Tesla versus its earnings, the two diverge completely just prior to the election of Trump. So there's definitely a correlation to that event. And so to repeat, I would say some very scary terrorist event could occur much more likely than before. Definitely world trade is hindered. So unfortunately, we expected that inflation would come down and so would interest rates, but we're now expecting interest rates to stay high because inflation will bounce up again with all of these tariffs and uncertainty. And then the price of the market. What do you think, Michael? What do you think is going to turn out?
Well, I mean, David, hearing your analysis, I tend to agree with the bulk of it, save for the path of inflation at this stage. I'm still in two minds because, and it does seem at this stage, Donald Trump is very intent on reducing the cost of one of the primary inflation drivers, and that is energy. And his policy has been to drill, baby, drill, and roll back a lot of the green subsidies in the US and in the IRA, the Inflation Reduction Act. And I think he's trying to, in a very Trumpian way, via tweets and muscularity, put pressure on OPEC and OPEC plus. And I think part of his deal with Russia would be, to some extent, to get Russian gas flowing into Europe and to bring down the cost of oil to the kind of middle 70s, which is where shale oil producers in the US would still be profitable, but where it isn't a very real material risk to inflation. And so I think part of his strategy is he's aware that tariffs on the one hand are inflationary, but he's hoping that inflation will be anchored on the other hand by his energy policies, and in that way you can also start bringing down the interest rate. Another area that Scott Bessent, his Treasury Secretary, is looking to attack is the 10-year Treasury yield. He's got this 3-3 strategy. He wants to get the US with a 3% deficit, 3% growth, and inflation and interest rates down to kind of closer to 3% as well. So that's the one area that for me still remains a little bit murky, but I completely agree with you around the geopolitical risks around the world have ratcheted up materially, given that we're in an age of unilateralism. I mean, to just sit down with Sergei Lavrov and discuss Ukraine without Zelensky there. It was interesting to see Macron actually demonstrate some leadership this week to say that Europe must come together. Europe must be able to determine its own future a little bit more forcefully, given the strained relationship with the US and the future of NATO. But I, to be honest, I would not be going long a market with all of these uncertainties, and so that's where I 100% agree. I would probably be loading up on inflation-linked bonds and a bit more insurance. But I want to come back to the idea of market narratives because much of this again is driven by narratives and what we convince ourselves to be true about the markets. And you've written extensively about the power of meta narratives. You wrote about it in orthogonal thinking, these idea trades. How much of today's market strength do you see is being driven by a really good, just feel good narrative versus what we're seeing as the fundamentals?
So I think a big part, like I would put it at something crazy like a 75% R squared, is driven by the inflection point narrative. So I call the inflection point narrative the Gen AI narrative. So the idea of the narrative is that we're reaching soon what's called the singularity, which is when the Turing test will be passed easily by AI, which is that an intelligent inquisitor will not be able to tell the difference in a voice response or a text response between a computer and a human. And if we were to reach that point, which is called the Turing test, or the singularity is when the computers think for themselves and start to have, that's the argument, is that this will create a justification for these high valuations. In my opinion, this is a replacement narrative for the blockchain narrative. So through our studies of, and when I say my research team, our studies of meta narratives and grand narratives and the occurrence of certain words like AI suddenly has become the most common word, in any search pattern, everything's about AI. You can see it in all advertising. These narratives are driven by the ideas of hopefulness of where the future is nigh. We're living in a time of great hope, and you see this throughout history. You see, for example, a lot of people don't know this, but electric vehicles were used in New York City in the 1920s. Electric vehicles are not new. So there were times where people used electric vehicles and it had an opportunity to flourish and then didn't. And people are not aware of the extent to which the hopefulness drives the markets. There was a very interesting movie I watched, and it's like a fun movie called Stupid Money, Dumb Money it's called, which is about the story of GameStop. I don't know if you know that
Yeah.
story.
Yes, yes. It was on Netflix, wasn't it?
Yes, yeah, it's actually quite a good movie.
Roaring Kitty.
Yes. The Roaring Kitty is a very good example of, you know, the hodl mentality. So the retail investor, the hodl mentality, and this idea that, you can't go wrong with Tesla's Elon Musk. Tesla equals Elon Musk. Elon Musk and Trump, it's unstoppable. He can do whatever he likes. And so people make very strange investment decisions as individuals, even as investment officers. BYD makes 10 times more vehicles than Tesla, but is valued at a 10 multiple versus a 100 multiple. Apple is at a 40 multiple. That is a bricks and mortar type company, but it's still a very, very high multiple. If you look at the constituents of the top 20 companies, 17, I think, in the world, 17 are from the US. And very, very few are from elsewhere. There's one from France, which is LVMH, and then you've got one or two others. One of them is TMSC, which is the Taiwan Semiconductor Corporation. So, this company is valued. There, I think it's in the $2 trillion range. I stand to be corrected. So the first 5 companies are in the $3 trillion range, then $2 trillion. This was never the case 5 years ago.
And what worries me about AI is, again, it's our biases and our recency bias, and we always just think it's the one who founds a new technology that captures the economic rents. But I think if history teaches us anything, it's not necessarily the initial movers. If you think of Cisco in the late 90s, the backbone of the internet boom, everyone thought Cisco was going to be $1 trillion company. It was going to capture the lion's share of the digital revolution. But internet connectivity became cheaper. We saw competition intensifying. Cisco's margins collapsed. And we saw the internet explode, but Cisco's stock never really reclaimed its dot-com peak. And so we saw the value capture shifted elsewhere. And I just think when we think about AI, will it be this revolution? I was reading in The Economist a couple of years ago when ChatGPT was first launched that some economists reckoned it would be one of those that was an order of magnitude like an industrial revolution that fundamentally reshapes economies and creates new growth. Or will it just be a revolution like the internet that does create new markets, but fundamentally, it doesn't mean that you justify PEs of 28 across the board. And I think what DeepSeek has certainly shown us is that the moats that we thought the chip manufacturers had, like an NVIDIA with its GPUs, are maybe not as large as we first assumed. And I think
Mm.
as competition increases and companies develop their own AI hardware, Apple, Meta, Microsoft are all researching that. NVIDIA's pricing power could evaporate. And so when you're trading at 25 times revenue with 75% gross margins, any margin compression then becomes devastating. But I think, this obsession with NVIDIA is emblematic of that larger problem, the extreme concentration of US equity markets. It just doesn't make
Yes.
sense to me and I'm inherently a value investor. If you look at the Chinese markets, to your point, and you've got BYD producing order of magnitude more cars than Tesla. In fact, it overtook China as the largest motor exporter in the world. And if you listen to the CEO and founder of BYD this week, as Xi Jinping went to make nice with the tech sector, they reckon they're 3 to 5 years ahead of the rest of the world, just in terms of the value chain. They've got an arm lock on the battery minerals value chain, the battery tech, integrate that with their component manufacturing, which they do very well at scale, as we know, as China's manufacturing has evolved over the last 2 or 3 decades. And so it just amazes me that the market doesn't see value there. What probably doesn't surprise me is that there's probably a deep discount because you're talking about companies operating in an authoritarian state. I mean, that's really what China is. It's communism or capitalism with Chinese communist characteristics. I think is the way they call it. So
Yeah. Yeah. I mean, Michael, if I could sort of champion and agree, is if I could make the point about AI, in order to convince me that the market should be 40% above its long run average and that NVIDIA should be where it's at from a price to earnings multiple perspective. And you'd have to convince me that there's a sustainable business model. We saw with PayPal that they were first to market, but then competition comes in, and then the tap, at the till, like the last few yards of the shopping line, are made easier by other technologies, including by Apple. So if you think about what AI is supposed to do, it's supposed to automate many human processes that are fairly drudgery type processes. Then you can see where some value sits. But currently, most of the business models rely on a subscription model. And we know subscription models don't generate enormous businesses. Even the Financial Times is a good example. It's a fantastic business. Economist, another great example. But they struggle to drive subscriptions, and those are the best of the best of the best. Then, with regards to competition, it's very obvious, I think, from the DeepSeek story that I believe that DeepSeek is a made up thing, that the hedge funds made up, that Chinese Communist Party has been researching it, working it very hard. It didn't come out of nowhere. So they just put a cover over it called a hedge fund, which no one had ever heard of. But it's indicative of how China wants to play this game. They want to say, we'll play also being like a kind of a tech bro. We'll also pretend that we have like great innovation. In the meantime, I think there's probably hundreds, if not thousands, of scientists dedicated. But I think they've probably cracked the code. They've probably figured out how you can use the results in a process called distillation.
wasn't it so ironic that you had Sam Altman of OpenAI crying about the fact that these Chinese models were training on the the data the OpenAI models, 4.0 and others are created through distillation, when that's exactly what Sam Altman has done with all of the world's information. And, he's ridden roughshod over
Yes.
copyright everywhere.
The point I made in a recent article I wrote was that he has not broken a copyright rule once or twice, but he's broken it ubiquitously across the board. It's the greatest copyright abuse since the invention of the printing press. Yeah, I think it's a market gone crazy. MAGA, and I'm not sure if you've read about this there's a new threat as well called the MAGA SWF, Sovereign Wealth Fund. So Trump is proposing a sovereign wealth fund. And if you think of sovereign wealth funds are these enormous funds that generate money on behalf of, and Norway's been the most famous, worth $1.8 trillion. Total sovereign wealth funds in the world are worth $13 trillion.
Generally on the back of resource endowments, yeah.
Resource endowments. And so the idea is that America will create a sovereign wealth fund, which will have very interesting consequences for global markets, because it will mean that America, which is the issuer of the fiat currency of the world, which is a huge advantage, which also has half of the equity market and more than half of the world's bond market, so equity and debt, will also be a major buyer and investor in the world's equities, large equity firms, assets, private equity, etc. So we're going to see an even greater concentration. If the US does launch a sovereign wealth fund, it will become a beast. Can you imagine the implications?
And the conflicts. Well, I mean, and the conflicts already, you just see it. I mean, I think if you had followed Nancy Pelosi's stock trading over the last 4 years, you would have outdone any hedge fund on planet Earth. There is so much glaring conflicts of interest, blurring of the lines between the political, the corporate, the regulatory capture that we've just discussed, taking place in the broader conversation around this battle between two great powers, between the US and China. So I suppose just as we round off our time together, David, and it's been a fascinating conversation, as they always are with you. We really do cover some varied and broad ground. If our systems, if our financial systems are just extensions of these collective narratives, is there a way to break free from it? Are we just inevitably bound by these stories and kind of pulled along by these idea trains?
Yeah, I think conversations like this to inform people that there's a 28 multiple on the S&P 500 and the long run is 18 is helpful. I would like people to, many investors lost their money on Trump's meme coin. The point was made recently in an analysis: a few Chinese investors made money on Trump's meme coin and most lost money. So I think there's a duty that, that we have in these conversations to inform people of the risks and the dangers and not be part of the stream.
And that really is the bottom line here. We as investors need to be aware of these valuations. And I think valuation in investing, I think Benjamin Graham was one of the fathers of value investing. And he said, it gives you a margin of safety. And when you're investing at record high, like historically never been seen before, maybe once during the dot-com boom, record high valuations, everything has to go better than perfect for you to be able to make money. When valuations are low, things can just be less bad and you tend to make money as well. And I think just the market's pricing AI's future as if it will only reinforce today's monopolies. But history suggests otherwise. And if that AI bubble bursts, NVIDIA has proven, then I think it could be a much larger reckoning for US equities. So David, always a fascinating, if somewhat existentially terrifying conversation that we have. Take care.
Always. Thank you, Michael.
Fantastic. Well, it seems that while we can't predict the future with certainty, we can at least make very educated guesses about the stories that we'll be telling ourselves along the way. Thanks for joining me on Business Talk, and I'm sure we'll have plenty more to discuss as the financial roller coaster of 2025 unfolds. To our listeners, thanks for tuning in. If you enjoyed this, be sure to follow Business Talk on businesstech.co.za for more. And of course, a healthy dose of financial skepticism. Until next time, stay sharp, stay skeptical, and try not to fall for the latest market fairy tale. Cheers.